Hello guys, welcome to Smart Commerce classes. My name is Sharoz Mumtaz, and in this today's video, we are going to discuss part 3 of external financial reporting or external financial statements, the statement of income and the statement of comprehensive income. Now, first, what is income statement? Income statement reports the result of an entity operation over a period of time. For example, 1 year. So, an income statement, also known as the profit and loss statement, it is a financial document that provides company summary of revenue, expenses, and profit or loss over a specific period. This period could be a quarter, could be a year, could be any other defined period. The income statement is one of three major financial statements alongside the balance sheet and cash flow statement. Balance sheet we have already discussed, and cash flow statement we will be discussed in our upcoming lectures. The income statement also provides the valuable insight of a company financial performance and profitability. Now, there are some elements of income statement. Now, these elements are revenue, gains, expenses, and losses. We will discuss in detail what is these all three or four elements that we are putting in income statement. Talking about the income statement elements, so there are some key elements or key component of an income statement. The first component is the revenue, or also known as sales. So keep in mind that revenue or the sales is not the profit. Profit we will only get after deducting the expenses. So first thing is revenue. Revenue is the total amount of money that earned from the sale of goods or services. It is also referred as the top of line because it appears at the top of income statement. The second element is expenses, also known as cost of goods sold or sometimes COGS. There are direct costs associated with producing goods or services that has been sold by the company. So this may be raw material, direct labor, or manufacturing overhead. Anything that is directly associated, that is only considered as a cost of goods sold. So after removing the expenses from revenue, we will get some gains or losses. And from this gain and losses, we will adjust the further expenses that can be operating expenses, that can be like, taxes or non-operating expenses. These all will be deducting after this. So these are four key components or key elements of the income statement. When we are talking about the income statement, we should also know why the income statement is important. The first thing, it helps stakeholder to assess how profitable the company is over a period of time. It also helps by examining the operating expenses of or the operating income. Stakeholder can evaluate how efficiently the company is being managed. Investor and analyst use the income statement to make informed decision about investing in the company. Lender use the income statement to evaluate the company's ability to generate profit and loss so that they can repay the loans. And management uses income statement to strategize, to set goals and measure performance against those goals. So we can say income statement is also a very important report or statement that has been used for external uses as well as for the internal uses as well. When we were discussing the balance sheet, we said that the balance sheet account are the permanent or real accounts. So the accounts that we are dealing in income statements are temporary accounts or also known as nominal accounts. Elements of income statement are temporary account because they record the transaction, event, and other circumstances during a period of time. These accounts are closed or reduced to the zero at the end of each accounting period, and their balance are transferred to the real account into the balance sheet. For example, profit or loss is transferred to the retained earnings. What does that mean? Income statement accounts are considered temporary account because they track financial transactions and result within a specific accounting period, such as a quarter or a year. Unlike balance sheet, they carry balances over period of to the next period. Temporary account are rest to the zero at the end of each accounting period. What are the characteristics of a temporary account? Temporary account record financially activity that pertains to a specific accounting period. This includes revenue, expense, gains, and losses. For example, sales. For the sales, we will record this is the sale for the year ended 2023, or we will record that the sale ended year ended 2024. We will not do like this. The sale that we have made in 2023 and carry forward to the next year, like 2024 sale. We will not do this. We will record each and every sale, or for a sale of each and every period, we will record them separately. At the end of each accounting period, the balance in the temporary account are closed or transferred to the permanent account. Specifically, retained earning account, the party of the equity section of the balance sheet. The process ensures that the accounting period performance is tracked separately. So we will know that the was the performance in our 2022, what was the performance in 2023, and what was the performance in 2024. So just to bifurcate the period separately, what we do, we close temporary accounts at the end of every period. Now, what is the closing process? What we do is all revenue are debited to zero to their balances, and the total is credited to their income summary account. And same goes for the expense. The next thing is the gross profit. Now, what is the gross profit? Gross profit is the difference between sales revenue and the cost of goods sold. If you want to get the percentage, you can simply divide the gross profit with the sale. You will get the profit margin. What is a gross profit? Gross profit is a key in a financial metric. It represents the profit a company makes after deducting the cost directly associated with the producing of goods or services, or also known as the cost of goods sold. It provides the insight how efficiently a company is producing its goods or services, and it's crucial. It's a critical indicator of a company core profitability before accounting operation expenses, taxes, and other operational costs. Keep in mind, there is a big difference between gross profit and the net profit. Gross profit is just we are deducting the cost of goods sold, the cost that is directly inculcated, that is directly linked with the producing of goods. There are a lot of other things that are not, directly linked or directly associated with the production. So gross profit is only the revenue minus cost of goods sold. The cost that has been incurred directly associating with the producing of goods. Let's take the example of a gross profit. Let's consider a simplified example of a company XYZ, which manufacturing and produces the sales widgets. Now, revenue from the sale widgets, let's suppose, is 500,000, and the cost of goods sold. Now, how you will get the cost of goods sold? You will get the raw material, for example, 150,000. You get the labor of 100,000. You get the manufacturing supplies or overheads for 50,000. So the total cost of the cost of goods sold is 300,000. How we will get the gross profit? From 500,000, we will deduct this 300,000, and 200,000 we will get. This 200,000 is the amount of our gross profit. The next thing is the standard cost and standard expenses. In an income statement, specific cost and expenses listed can be significantly depending on the nature of business. This variation arises from different industries and types of business that have a unique operation, production process, and cost structure. A typical cost and expenses might differ across the various type of business. Let's take an example of manufacturing business. In manufacturing business, there will be a cost and expenses. How we will get? There are two types of expenses: cost of goods sold and the operating expenses. What are the cost of goods sold? This include raw material, direct labor, manufacturing overhead, factory utilities, equipment maintenance, anything that is directly related to producing the goods or services. In operation expenses, we will say like the selling expenses, advertising expenses. We are giving some commission. So these are the things. So in generally, there are. I have just list down some standard cost and expenses. The first is the cost of goods sold. Second is operating expenses. Third is the depreciation and amortization. What is depreciation? Whenever you purchased an asset, you are using it over a period of time. The value of this asset goes down. This going down value, we will call it the depreciation of an asset. And amortization, if the value of an asset goes up with the passage of time. So we will call this amortization. Interest expenses and is also in a standard expense. Income tax and non-recurring expenses are also considered as an expense that are standard in a business. The next thing in our today's class is the matching principle. The matching principle is a fundamental accounting concept used to ensure that financial statements accurately reflect the financial performance of a business. The matching principle states that expenses should be recognized in the same accounting period as the revenue they help to generate. This principle ensures that all the costs associated with the earning revenue are recorded in the same period as the revenue itself, providing a clearer picture of a company's profitability and financial performance during that period. Now, how it works? Revenue is recognized when it's earned, regardless when the cash is received. This is also known as the accrual basis of accounting, which records the financial event based on that when they occur, when instead of whether the cash transaction happened. So same goes for the expenses as well. Expenses are recognized in the same period as the associated revenue. It means if a company incurs a cost during a contribution of earning a revenue, these costs should be recorded in the same period to the related revenue. So why it's important? By matching principle, revenue related to the financial statement give us more accurately to reflect the company's performance and profitability for a given period. And it also helps us to make a better decisions. So now the next thing is it is a compliance with GAAP as well. The matching principle is a key component of a GAAP. As a matching principle, a compliance with the GAAP, it is a key component of the GAAP and also for the IFRS as well. It ensures the consistency and the reliability in financial reporting. So there are also some challenges while making the matching principle. Sometimes it can be challenging to directly associate some expenses with corresponding revenue. Companies may need to use estimates and judgment to allocate the cost appropriately. For complex and long-term projects, matching expense with revenue can be more complicated and may require more sophisticated accounting method, such as percentage of completion for long-term contracts. So, in summing up, we can say that the matching principle is crucial for accurate financial reporting as it ensures that all the costs associated with generating revenue are recognized in the same period as the revenue itself. This alignment provides a true and fair view of a company profitability and financial health, adding stakeholder in making well-informed financial decisions, and they will also get a transparent and more reliable data as well. Share-based payment and employee benefits. So first I will discuss what is the share-based payment. A share-based payment is a transaction in which an entity receives goods or services in exchange of their own entity instrument, such as share or stock option, or incurs liability to settle the transaction for amount based on the price of entity instrument. This concept is primarily governed by the accounting standards such as IFRS 2, that is International Financial Reporting Standard 2, and ASC 718 in United States. There are two types of share-based payment. The first is the entity settled share-based payment. In this transaction, the entity issues entity instrument such as shares or stock option to employee or to other parties in exchange of their services. The recipient has right to receive shares in company. It also includes stock option, restricted stock unit, that is RSU, and employee stock purchase plan as well. That is ESPP. Share-based payment give another benefits as well. Share-based payment, particularly stock option, can align employee interest with those of the shareholder, motivating employee to work towards increasing the company's share price. By compensating employees with the equity rather than cash, companies can conserve the cash, and which can be crucial for startups and growing business. Offering stock option and share can be attractive incentive for recruiting top and talented, especially in competitive industries. There are also some challenges for doing this. Determining the fair value of share-based payment can be complex, required sophisticated model and assumptions. Issuing new shares can dilute the ownership of existing shareholders, potentially affecting the share value and control. The requirement of the organization share based, such as expense, can impact the company reported profitability, which may not be fully understood by all the stakeholders. Summing up the conversation, we can say share based payment are crucial tool for compensating and incentivizing employees and other parties. Other significant benefit in terms of alignment of interest and conversation of cash. However, they also present challenges in the valuation, accounting complexity, and potential illusion of ownership. Understanding and properly accounting for share-based payment are essential for accurate financial reporting and effective financial management. Next, the employee benefit. What are employee benefits? Employee benefits are various types of non-wage compensation provided to employees in addition to their normal wage or salary. These benefits are essential component of an employee's total compensation package and play a significant role in attracting, retaining, and motivating employees. Here I am giving you some examples like health insurance, retirement plan, paid time, vacation, sick leave, life insurance, disability. All these are employee benefits. It also includes the wellness program like gym membership and tuition reimbursement. This aim to enhance the overall compensation, attracting and retaining the talent. It promotes employee that their well-being and satisfaction is important for the company, and that can vary significantly between the industries and the companies. So I will give you just a brief. There can be health and wellness benefits. Now, what are the health and wellness benefits? It covers the medical, dental, vision. This is often one of the most critical benefits for the employees. And the wellness programming initiative to promote health and fitness, such as gym. Then we can give them the financial benefit. The financial benefit can be their retirement plan, the stock options, bonuses, and the tuition reimbursement. This kind of benefits are also known as the financial benefit. Then we can give them paid time off, like vacation, sick leave, holidays. We will give them all these benefits to give them the work-life balances. What are the challenges now for doing this? There are some challenges to giving that employee benefits. These challenges can be vary to industry. While managing the employee benefit, there are a lot of challenges. The first challenge is the cost management. Offering comprehensive benefit can be expensive for employers, requiring careful planning and management to balance cost and benefit. Compliance will also make a challenge for management. Employee must navigate a complex landscape of laws and regulations related to the employee benefits, such as the Affordable Care Act in the US. Employee will make a customization. Employee have a diverse need and preferences, make it challenging to design benefits package to satisfy everyone. Summing up the discussion, we can say that employee benefits are crucial element of total compensation and play a vital role in overall employment relationship. By offering a well-rounded benefit package, employers can attract and retain talent, improve employee satisfaction and well-being, and ultimately enhance the organization overall performance. Effective management of employee benefit requires a strategic approach that balances cost, compliance, and employee needs. In the income statement, we have already discussed the cost of goods sold or the COGS or CGS. But there are also some other expenses as well. The first one is the administration and the general expenses. Administration and general expenses, often refers as an overhead cost, are the expenditure necessary to run the day operations of a business that are not directly tied to producing goods or services. This includes the salary of administrative staff, office supplies, utilities, insurance, rent for office space, and professional fees such as legal account fees, accounting services fees. These expenses are crucial for maintaining the infrastructure and operation of company, but do not directly contribute to the production or sales process. The next one is the selling expense. Selling expenses are the cost associated with the effort to sell a company's product or services. These include expenses such as advertising, promotion cost, sales commission, salary for sales staff, traveling expenses related to sales activity, and the cost of maintaining showroom or retail spaces. These expenses are directly related to the sales and essential for driving revenue by promoting or selling the company offering or the promotion of the company to the customer. And the third one is the interest expense. Interest expense are the cost incurred by a business for borrowed fund, typically in the form of bond, loan, leases. These include interest paid on loans bank, interest paid on bonds issue, and all kind of these interest. This is also recorded as in income statement as a financial expense, and it also impacts the net income of the business. Talking about the income statement format. So there are two types of income statement format. The first one is the single step income statement, and the second one is a multiple step income statement. What is the one step? In one step income statement, what we will do, we will sum the revenue of all the products. As we know, nowadays a company is making variety of product. They are making different products under the same name. So what they will do, they will sum all of the revenue that have been generated from various different products, and then they will deduct the expenses from different products, and they will get a profit. So for example, the income of A plus B plus C is equal to X, and the expenses of A plus B plus C is equal to Y. So what they will do, they will just deduct Y from X and they will get the profit. This is what the single step income statement is. Now the multiple step income statement. Multiple step income statement is more reliable as compared to single step, because in multiple step, we are deducting the expense of a product from the revenue of that particular product only. In that case, we will get the more reliable and the transparent information about the product. In income statement, that is single step, we will get the net amount. We don't know which product is making profit and which one is going in the loss. But when we are talking about the multiple step, we will get the each and every information, like which product is performing well and which product is giving us how much of the profit. So that's all for the income statement format. The next thing is reporting the irregular item. Irregular item in financial reporting are events or transactions that are not the part of ordinary business activities and do not occur frequently. They are separately reported to give users of financial statement a clearer view of a company's normal operation and financial performance. There are two types of irregular items. First one is the defective or damaged items. And the second one is discontinued in operation. So what are the defective and damaged items? Defective or damaged items are the product that cannot be sold at their nominal price or their normal price due to defects or damage. These items results in a loss of a company and typically reported under the cost of goods sold as a separate line of item, and if the losses are significant, reporting these involves writing down the inventory and it is net realizable value, which reflects the total of lower cost of market value. The loss from damaged or defective item is recognized in the period it occurs, and it is clearly disclosed in financial statement to provide the transparency about its impact in the profitability. Discontinued operation. Discontinued operation refer to the components of a company that has been disposed of or are classified as held for sale. Reporting discontinued operation involves two key components. The first one is the result of discontinued operation. The income or loss from the discontinued operation for the period is reported separately from continuing operation and the income statement. This includes revenue, expenses, gains, or loss that are directly related to the discontinued component. By segregating this information, user can access the performance of remaining continuation of operation without the influence of discontinued segment. Second is the gain and loss from disposal. When the sale of discontinued component occurs, any gain or loss from the disposal is reported separately from the operating result of the discontinued operation. This includes difference between the proceeds from the sale and carrying amount of the net asset of discontinued operation. This gain or loss is also presented at the net of tax and provide clarity on financial statement what is the impact of that disposal transaction. By clearly reporting discontinued operation and other irregular items separately, financial statements offer a more accurate reflection of a company's ongoing financial health and operational performance, allowing stakeholders to make more informed decisions. Reporting irregular item. Now, what the standard say about it? Accounting Standard Update 2015-1. Income statement extraordinary and unusual items removed the concept from extraordinary items from US GAAP for both public and private sector companies. The separate net of tax presentation is not allowed. An entity is required to separately present that item that are of an unusual nature or occur infrequently on a pre-tax basis with the income from continuation operation. The standard took effect from the fiscal year beginning after December 15, 2015. What does that mean? The update that has been issued by the Financial Accounting Standard Board (FASB) eliminated the concept of extraordinary item from US GAAP. This means that public and private sector companies can no longer present the extraordinary item, which are previously shown as a net of tax on their income. Instead, companies must present these items of an unusual nature or occur frequently with the pre-tax income from the continuation of operation. This change effect for the fiscal year from the beginning of 2015 aims to simplify the financial reporting and provide more consistency and clarity in how unusual or infrequent events are reported, ensuring that financial statements are offer a more straightforward view of a company's operation and overall performance. The next thing is the note and disclosure. Notes and disclosure and schedules specifically related to the income statement, and these include the following: earnings per share, depreciation schedule, component of income tax expenses, component of pension expenses. First, what is earnings per share? Earnings per share or EPS is a critical financial metric disclosed in the notes of income statement, indicating the portion of a company profit allocated to each outstanding share of a common stock. EPS is calculating by dividing the net income to the common stakeholders by weighted average number of the common shares outstanding during the period. There are two types of EPS, basic and diluted. Basic earning per share does not consider the potential dilution from the security, such as stock options or convertible debts, while diluted earning per share accounts are those potential dilutive securities, providing more conservative view of earning attribute of each share. Disclosing EPS involve investor access and company's profitability on a per share basis, facilitated comparison across period and with other companies. After earning per share is depreciation schedule. Depreciation schedule detail the depreciation expenses allocated to the various assets over their useful life. This note include information about the method of depreciation used, such as a straight line or declining balance, the useful life of different asset categories, and their total depreciation expense for a period. Depreciation schedules help user of financial statement understand how the company allocates the cost of tangible asset over a time, reflecting the wear and tear or obsolescence of their asset. This disclosure provides insight of a company asset management and practices that impacts its profitability. Components of income tax expense. Component of income tax expense note provide a detailed breakdown of the total income tax that expense reported on their income statement. This disclosure typically includes current tax expenses, the taxes payable for the current period, deferred tax resulted from temporary differences between the accounting and tax treatment, and any adjustment prior to the periods. It also outlines the reconciliation between the statutory tax and the effective tax rate, highlighting two factors such as tax credit, non-deductible expense, and differences in the tax across the jurisdiction. This detailed breakdown helps stakeholders to understand the company's obligation and the factors influencing their effective tax rate. There are a lot of good things about the income statement, but also there are some limitations on income statement. The first limitation is that it doesn't capture the non-monetary items. The income statement focuses primarily on financial transaction and monetary values, meaning it doesn't capture non-monetary items that can significantly impact a company's performance and prospects. For example, factors such as employee morale, brand reputation, customer satisfaction, and intellectual property value are not reflected in the income statement. These non-monetary elements can influence the future profitability and operational effectiveness, but their exclusion from financial reporting limits the comprehensiveness on income statement. The second limitation is that is subject to accounting estimates. Many figures reported in the income statement are based on accounting estimate, which can introduce subjectivity and potential bias. Estimates are used in areas such as depreciation, bad debts, provision, inventory, obsolescence, and warranty liabilities. While necessary for financial reporting, these estimates are based on management's judgment and assumption, which may always not be accurate. This reliance on estimate can affect the reliability of comparability of financial report or the financial performance, making it challenging for stakeholders to fully access the company's true financial health. Another income statement limitation is it doesn't reflect the time differences. That means it is accrual basis. Income statement is prepared using an accrual basis of accounting, which recognize revenue when it's earned and expected and the expenses when it's occurred, regardless of cancellation occurred. While this provides a more accurate picture of operation performance, but it can create a timing differences that may not align with the actual cash flow. For example, revenue recognized on the credit sale or expenses recorded on accrued liabilities might not immediately affect cash. This disconnect can obscure the company's short-term liquidity position and cash flow dynamics, and limiting the statement utility in assessing the cash management. Last but not least, the income statement limitation is it doesn't provide a future outlook. Income statement is a historical document that reflects a company's performance over a specific period, but it does not offer insight into the future prospects. While it shows past revenue, expenses, and profit, it lacks information about the future earning potential or upcoming market opportunities. or strategic initiative. Investor and other stakeholders need forward-looking information as well, such as management forecast, market trends, and growth plans to make more informed decisions. The absence of such predictive information limits the income statement usefulness of long-term planning and investment evaluation. The next thing is the statement of other comprehensive income or OCI. The statement of other comprehensive income is an important financial statement that provides a comprehensive view of a company's financial performance by capturing the item of income and expenses that are excluded from the income statement. While income statement focuses on net income, which encompasses revenue, expenses, gains, and losses recognized during the reporting period. The statement of OCI represents that directly impact equity without affecting the net income. These items include foreign exchange, translation adjustment, unrealized gains and losses, or available for sale securities, changes in the fair value of cash flow hedges, actuarial gain and losses. So, by presenting these items separately, the statement of OCI offer a more complete information of the changes in the company equity during a period, reflecting economic events that can affect the company's financial position. Did it include that events that are not the part of regular operation performance? This separation enhances the transparency and helps the stakeholder for better understand of overall financial health and the long-term viability of a company, as well as the potential impact of a market fluctuation and other non-operational factor on their activity. The next thing in the OCI is unrealized gain or losses on cash flow hedges. Unrealized gain or losses on cash flow hedges relates to the derivative instrument used to hedge forecasted transaction or variability in the cash flow. These hedges aim to protect the company against risk such as changes in interest rate or commodity prices. The effective portion of the unrealized gain or losses on the hedging instrument is recorded in the OCI until the hedge transaction affects earning. This approach ensures that the impact of hedging activities on company financial performance is recognized in the same period as underlying transaction, providing a more accurate representation of risk management strategies. Next thing is the pension adjustment or actuarial gain and losses. Pension adjustment, including actuarial gain and losses, arise from the changes in the value of a defined benefit pension plan assets and obligations. These can result from differences between the actual and the expected returns on the plan assets. Changes in actuarial assumptions such as discount rate or life expectancy and experience adjustment, these gain or losses are recorded in the OCI to smooth out the effects of short-term volatility in the pension plans and to provide a clearer view of a long-term impact of a company's financial health. This treatment helps maintain stable income figures while reflecting the true economic cost of providing pension benefits. The next thing is the statement of other comprehensive income or OCI. The statement of other comprehensive income is an important financial statement that provides a comprehensive view of a company's financial performance by capturing the item of income and expenses that are excluded from the income statement. While income statement focuses on net income, which encompasses revenue, expenses, gains, and losses recognized during the reporting period. The statement of OCI represents that directly impact equity without affecting the net income. These items include foreign exchange, translation adjustment, unrealized gains and losses, or available for sale securities, changes in the fair value of cash flow hedges, actuarial gain and losses. So, by presenting these items separately, the statement of OCI offer a more complete information of the changes in the company equity during a period, reflecting economic events that can affect the company's financial position. Did it include that events that are not the part of regular operation performance? This separation enhances the transparency and helps the stakeholder for better understand of overall financial health and the long-term viability of a company, as well as the potential impact of a market fluctuation and other non-operational factor on their activity. This is the last thing in our today's class, that is the element of other comprehensive income. What are the elements of other comprehensive income? The first one is the foreign currency translation adjustment. Foreign currency translation adjustment arise when a company has subsidiaries or operation in foreign countries and their financial statements are consolidated with into the parent company financial statement. These adjustments occur due to the fluctuation in the exchange rate between the functional currency of a operation and the reporting currency of the parent company. The resulting gains or losses from translating the financial statements of foreign subsidiaries are included in other comprehensive income to reflect the impact of exchange rates on a company net investment on in foreign operations without affecting the current period of time. The next is the unrealized gain or losses on available for sale securities. Unrealized gain or losses on available for sale securities represent changes in the fair value of their investment that have not been realized throughout a sale. These securities are typically debt or equity instrument that a company does not intend to hold to a maturity or sell them in near term. The unrealized gain or losses are reported in OCI to provide a clear picture of potential future gains or losses without affecting the current period net income. This separation involves investors understand the company's potential financial position while keeping the net income stable for the short-term market fluctuations. The next thing in the OCI is unrealized gain or losses on cash flow hedges. Unrealized gain or losses on cash flow hedges relates to the derivative instrument used to hedge forecasted transaction or variability in the cash flow. These hedges aim to protect the company against risk such as changes in interest rate or commodity prices. The effective portion of the unrealized gain or losses on the hedging instrument is recorded in the OCI until the hedge transaction affects earning. This approach ensures that the impact of hedging activities on company financial performance is recognized in the same period as underlying transaction, providing a more accurate representation of risk management strategies. Next thing is the pension adjustment or actuarial gain and losses. Pension adjustment, including actuarial gain and losses, arise from the changes in the value of a defined benefit pension plan assets and obligations. These can result from differences between the actual and the expected returns on the plan assets. Changes in actuarial assumptions such as discount rate or life expectancy and experience adjustment, these gain or losses are recorded in the OCI to smooth out the effects of short-term volatility in the pension plans and to provide a clearer view of a long-term impact of a company's financial health. This treatment helps maintain stable income figures while reflecting the true economic cost of providing pension benefits. Component of pension expense. The component of pension expense is note provide a detailed analysis of costs associated with a company's pension plan. This typically includes the service cost, the present value of benefits earned by employee during the current period, interest cost, the increase in the pension obligation due to the passage of time, expected return on a plan asset, the estimated earning on their fund, set aside their pension, and the actuarial gains or losses. It may also cover the effects of plan, amendments or settlement. Disclosing the components of pension expenses helps stakeholder understand the financial impact of pension obligation on the company's profitability and provides insight to the management of employee benefit plans. Changes in the fair value of certain financial instrument. Changes in the fair value of certain financial instruments such as those classified as fair value through other comprehensive income under IFRS or available for sale under US GAAP are recorded in OCI. These adjustments reflect the unrealized gain or losses due to the market value fluctuations of these financial instruments. By recording these changes in OCI, company can provide the transparency about the potential impact on their financial position while recording the volatility and that will affect the net income if these changes were recorded immediately in their income statement. Revaluation of property, plant and equipment under IFRS. Under IFRS, company can choose to revalue their property, plant and equipment to reflect the fair value rather than the historical cost, that is the purchase cost. The resulting revaluation, surplus or deficit is recorded in OCI. This treatment allows company to update the carrying value of their PPE to current market conditions, providing a more accurate reflection of asset on their balance sheet. The revaluation adjustment in OCI ensures that these changes do not impact the net income, thereby maintaining a stable income statement while reflecting the true economic value of long-term tangible assets. So that's it for our today's class. Thank you for watching. And if you found this video helpful, don't forget to give it a thumbs up and share it with your friends. For more in-depth CMA course content and updates, make sure to hit the subscribe button and click the bell icon so you can never miss an upload. Do you have any questions or topics that you would like to cover? Leave a comment below and I will be sure get back to you. Follow us on our social media channels for additional tips, resources and community support. Thank you again for your support. Keep learning and see you in the next video. Thanks for the watching.